Hello friends, welcome to AARDHA. In this video, we'll see various types of savings and investments and which one grows your money better. See why we must need to understand the difference between savings and investment because these are the main problems. With savings, money loses value to inflation. For example, saving account gives about 3 to 4% returns, right? But inflation is around 7%. So your money loses purchasing power. So solution for this is to invest your money. Investment can give 10 to 15% returns, beat inflation and grow wealth, build long-term financial security. So you need to understand this to make better choices. Now let's see the difference between savings and investment. See, purpose of saving is to preserve money, whereas investment is to grow money. Risk level in saving is low, whereas in investing it is medium to high. Returns, savings gives 2 to 6% returns, while investing gives 7 to 15% return. Liquidity is high in savings, and in investing it varies depends on the product. Examples for savings are FD, RD savings account. Examples for investment is mutual fund, equity and PPF. Now let's see various types of savings instruments. The first one, savings account, it gives 3 to 4% interest. Here liquidity is very high, and this is suggested for daily use and salary. Fixed deposit gives returns somewhere between 5 to 7%. Here, fixed deposit, your amount is locked for certain period. Only 5 lakhs is insured under DICGC. Sweep in FD. Here, I suggest you use sweep in FD instead of FD or keeping your money in savings account, because here you will get higher returns similar to FD, but liquidity is uh, as good as savings account. Here it gives flexibility and also some good returns. So go for sweep in FD in case you are using bank accounts to park your funds. Now let's see what recurring deposit is. Here you need to make monthly deposits in recurring manner. This is suitable for salaried individuals. Post office savings, as it is government backed, it is very safe and ideal for rural savers because every post has this post office savings account. Sukanya Samriddhi. Here, if you have girl child, you can use this Sukanya Samriddhi. Here, higher interest is given, and these investments and returns are tax free. Senior Citizens Savings Scheme. Here, 7 to 8% safe income from government backed scheme. This is exclusively for retired individuals aged 60 plus. Here, minimum tenure is 5 years with an option to extend by 3 years. Maximum investment limit is 30 lakhs as of recent rules. Here, quarterly interest payments are given, so it can be used as regular income source. Tax benefit under 18C is available for principal amount. Now let's see various types of investment instruments. First one, PPF, Public Provident Fund. Here 15-year login is there. Tax free, you can get tax free returns. This is very safe as it is a government scheme, and it is useful for long term. Mutual funds, SIP friendly. Here mutual funds, you can use SIP options. Systemic investment plan. You can invest equated amounts in monthly. These are regulated by SEBI. Mutual fund may be debt, equity, or hybrid. ELSS, Equity Linked Savings Scheme. Here, ELSS is a mutual fund in which your fund locks your amount for 3 years. Here, ITC tax benefit is there, and also equity growth potential is available for your fund. Stock market. In stock market, you get high returns, but here risk is slightly higher. Here, direct ownership of the stock is given to you. This is useful for long-term growth. NPS, National Pension Scheme. This is retirement focused. Partial equity exposure is there. 80 1B benefit available. Sovereign gold bonds. RBI issues these on behalf of government. Tenure is 8 years. Here you get 2.5 interest on the amount plus price of the gold gain, tax free at maturity. Now RBI stopped issuing these bonds. Some more investment options are like REITs, real estate investment trusts. Here rental income, uh, here you will get rental income of the real estate companies. This is used for diversification. Corporate bonds are NCDs. These are fixed income bonds regulated by SEBI. Here credit risk exists. Now let's discuss on what's right for you. It basically depends on your goal. Short-term safety is your requirement or long-term growth. That is the main thing. How much risk can you handle? Low, medium, or high? Do you need tax benefits or not? Can you lock in funds for years or need liquidity? Diversify your portfolio. This is a must. Don't put all eggs in one basket. Review and rebalance every 2 to 3 years to stay on track. Here, these are the common misconceptions to avoid. People think that FD is the safest, but only 5 lakhs per bank is DICGC insured. Mutual funds are only for experts. This is false because SIPs makes them beginner friendly. Gold jewelry is the best gold investment. This is another misconception because gold is not liquid. Also, high making charges are occurred. Real estate is always profitable. This is not always true. You need to research. Crypto or forex trading is safe, false, unregulated in India, very risky. Now let's see some practical cautions. Don't use one size fits all approach. Diversify your portfolio. Avoid Ponzi schemes, sit funds, and fake investment apps. Always read lock-in periods, penalties, and exit terms carefully. Mutual fund returns are market linked, not guaranteed. Choose only SEBI, RBI, AARDHA approved platforms and schemes. Never, never fall for guaranteed high return promises. It's a red flag. See, this is like savings is safety and investments are for growth. Start early, stay consistent, review annually. Rebalance every 2 to 3 years. This is end of our discussion on this topic. Please let me know if you have any doubts or suggestions in the comment section so that I can get back to you. Thank you.